All right, guys. So we're on the Euro USD. I'm on a 1 hour chart. We have a double bottom. I'm sorry, a double top that played out. So this was pretty good. We were able to get down to around 39 between 40 pips. Remember, as contrarian traders, we typically don't. Our first targets are never the actual target of a double bottom or a double top. We like to trade back to the neckline. Um, that is how we find our, safest, trading route. However, we can find entries to get to the secondary target. So, like over here, target did get hit. So we use Confluent. Let's take this one right here. We mark off zones on a chart where we are looking for Fibonacci levels. And if these targets fall at key Fibonacci levels, we will also, consider this for our secondary. For our secondary targets. So if you notice, it's the 61%. All right, so it hit the 61%. So this could be an area where we could actually either have a move target number one to the actual target, or just have a bracket order where we have order execute that we'll get out at the neckline, and then we'll have another order, the second order, get out at the 61%. All right, so that's one of the ways we use Confluence with the markets. And I'm going to reiterate that a lot of you guys, trading does work. It's still that the risk management is off, your emotions are off. And the only way you're going to overcome that is that you're going to have to stay in the game, trade, keep making your mistakes, whatever you need to do. All right, so this is a pretty decent one right here. It hasn't played out yet, but how we do want to monitor now. I probably want to see this earlier in the move, but there could be some opportunities. All right, so if we see something like this, we see that this area is all considered a some form of a demand zone. All right, and we see prices come in and reacted off of this particular zone. So we have to be mindful when prices like this, even though we still want to try to get to the neckline, right? So what we could do is we could go down to a lower time frame. We go like to the 5 minute, and what do you notice? Like on the 5 minute, a lot of our necklines have been hit, and but we do have a target area that's down here as well. So we possibly could be looking for some entries if we had to go short. So that's pretty decent between 19 and 20 pips to get to that particular target if we were to take it to the traditional target area. So you see what happens when you go on a lower time frame. You get to see different structures that are playing out. All right. So this structure right here, this could be considered. Some people call it the H pattern. Where's my tool drawing tool? Where are you? Right here. So see how like an H. All right. Now some people call it the H pattern. In reality, guys, it's really a bear flag, right? So that's what it looked like. You got your pole right here, and we got a bear flag pattern right there. Let me take off these. All right. So you see how this look, and this will be the target if this plays out. All right. And trading on a 5 minute chart too also helps with stop losses. So if you're on a bigger time frame, of course, your stop loss is going to be a lot bigger. So you take something like this, and let's say you want to put your stop loss above um, the so-called flag pattern construction. All right, so you're talking about 13 something pips. I mean, it's pretty decent. But if you go on a higher time frame and you start messing around with structure, this is what it possibly could look like. So let's say you want to put a stop loss, whatever, up here. From here, you see the difference. So you're talking about 30, 34, 35 pips as well. All right. So yeah, just keep that in mind as well too. All right. So this could be considered. We got a supply area up here. We're having some resistance in this area here. So we could see this is forming as a double top. Right? So you see this right here. This is somewhere like a what we call an inverted, not an inverted, sorry, a diagonal, um, a double top. We call them zigzags in the market. And so how we, like I said, how we really capitalize is that we don't go for the traditional target. So for traditional trader would have saw this, they would have had a target somewhere down here because all you have to do is just measure from top down to the neckline, and you just move your like that. So this is the traditional target. Well, what happens is they enter, all right, and then if trades comes back against them, wipes them out, and they feel like they're wrong. So to increase our probability of winning, we don't even fool with that. We would have been fine because we got back to the neckline. And what this does is that it helps us also counter as well because a lot of times the neckline serves as a trend continuation. You see how price comes down here. What happened? We found um, some support, and this was what? This was a demand area. All right. You see, you take the last red candle before we had an engulfing candle out of this zone, and this whole entire zone right here is a demand zone. You see this red candle? We get an engulf. All right. So this is a demand zone, push up, demand zone, push up. So all right, if we know that, if you look left, if you're doing a double top or bottom, doesn't matter. You gotta look left and you gotta respect these zones. So if I'm gonna respect these zones, I'm not anticipating just to hold through this particular zone because it's holding. All right, we had a nice little uptrend. We got higher highs, higher low, higher high. Higher lows, finding that support area, and we bounced off of. So why would I want to keep a short trade in? This area has to be violated and price has to close below it before I can even consider it, even taking it down to those targets. Same thing is happening over here. All right. So you see, I'm not just jumping in, even though I went down to the 5-minute chart. Look what's happening. This is a key area. We still could push higher. All right. Look what happened. Look at this. Let's take all this off. Now let's just keep it simple. Where are we? Where are we? We were um, right here. Let's look at this one. So you see what I'm doing? I'm finding the last candle before price moved out of a zone. So, all right, this candle moved us out of the zone, but this was the last candle. So I take it from the height and to the bottom. This becomes my demand zone. Now, how would it work for a supply zone? So look at this one right here. All right, you had a green candle, and some people call this the banker's candle. You had a banker's candle. All right, this the liquidity grab. All right, and then this was the last green candle before we made our drop. So we can do the same thing. Go over here. Just drag it a little bit down to there. This is a what? This is my new supply zone. So you see how price comes in and finds it struggles to come out of here. Every time it comes in here, it's doing it. But then we finally get a break. All right, we get a break above. And so here's where your conservative traders come in. They see the break. They don't just take the trade. They say, I'm going to wait till price come back into the zone, and I'm going to take the trade to go long, and my stop loss will just be right below this structure. And you can repeat this process over and over, guys. This is just simply supply and demand. And double bottoms and double tops are nothing but supply and demand trading patterns. So, specialize in that. If you're watching this video, I really want you guys to just focus on mastering one trading strategy and stick with it and do it over and over again. Because here's the thing, you're going to have to uh, overcome whatever deficiencies you have. That's your battle. That's your fight. It's no one else's. But I mean, look what's happening, right? What happened? We had an area right here. Now, here's a good thing. This is a good one right here. So we had this big long red candle, and of course, could you consider this whole entire zone a demand zone? Because look, you see all these engulfing candles. These are just big ones, right? So when you have something this big, we typically don't want to try to use those as these big candles as supply and demand zones, so to speak. So watch this. So let's go down to a lower time frame. Let's maybe go to 15 minutes, and we can maybe see some things look different. And we do. So you see how it changes a lot. It's a lot better to work with, because if I'm going to wait on an hourly for hourly candle to be engulfed, I'm gonna be there forever. So look at this. All right, we had this, and then this candle what engulf. So this was the last candle. So what are we gonna do? We're gonna draw this as I what demand zone, and we're gonna draw all the way across. And look what price is doing, guys. Look what price is doing. Bam, bam, bam. All right, come on now. And of course, I got a thing I can show y'all another video how to, I have to keep dragging it. In fact, I show you now. Right click it, go to settings, and you see where it says extend right. So you see how it just on the screen extend right. All right. So that every time you use your rectangle box, it'll automatically extend right forever. So you can use that if you don't feel like dragging it. All right. So I just showed y'all something. All right. So yeah. So when you on an hourly chart and you see that you got those big candles like this, right over here. So you see this right here. See this? Like that's so this is what you don't want to do. You don't want to you see that's too much of a zone. Even though we know price coming in zone, but this doesn't tell you anything. That's just too wide. All right. So you want to be able to narrow that down. Only time you if you want to do swing trading and you may want to go to the 4 hour chart, you can use uh, those particular candles. Uh, but it comes at discretionary. So you need to be able to say to yourself, hey, this is too wide of a zone. Let me go down to a lower time frame. So like, look at this one right here. This is the last candle before we reverse. So look, we engulf this. So guess what we're gonna do? We're gonna have this candle, and we're gonna take it from the top, and we're gonna take it down to the bottom, and then we're gonna stretch it across. All right, and then this could be considered a supply zone. So guess what? When we got to this supply zone, we did have some rejection, and this is a 4 hour chart. So you still probably could have found uh, some trade setups, but at the end of the day, we never really violated this little support level right here. We never really got. We just kept pushing higher. So that happens. So guess what, guys? Everything's not going to be peaches and cream. So someone up here, for whatever reason, a lot of people. This is a supply zone. Everybody is being taught to go short, but guess what? This is also called inducement. All right, you're being trapped. This is a big, huge bear trap. Because why? This is a supply zone. Price should be dropping, and then they get teased. Look, we get these drops. So look, I'm on a 4 hour chart. So these are a lot of pips. Look at it. That's 122 pips right there. This one from down to here, that's 149 pips. So you see, that's a lot of tug of war going back and forth to thinking that we're going to get this massive drop. All right, and then we get this final push, up here, and they're just wiping out all the liquidity that's up here. But guess what, guys? The Japanese yen is a safe haven. It's the British pound, Japanese yen. For what I'm seeing, we still are shaping up to literally get this drop. All right, and we have a pretty good case to shaping up. All right, we're at an 89 pip drop. But we want to start seeing how we can wipe out these areas, and if we can, then we can start getting. All right, this will be your first area you want to really look at. That's 500 pip drop to get down to this area. Okay, and once again, we can look at our what Fibonacci retracement levels, and that can give us some key levels of where we possibly could drop to. And my key area, I want to see how price really reacts to this 23% retracement area. But if we can get and break and get down, my key area I want to come to is the 61%. So where we currently are, like I said, that's about 510. And if we get to the 70, 590, it's not bad. All right. So hit the like button, subscribe. None of this is financial advice. It's your boy E. White, Dark Horse Investor. Hope y'all have a wonderful day. Remember, stick with it. Uh, Continue to be disciplined and drown out the noise, and just stick with your trade plan. And know that every trade plan works, every trade plan fails, but you are the jockey. You got to ride this horse, and you got to make sure you're steering in the right direction, but stick with it. All right. I'm out. Enjoy your day.